Understanding how options are priced is essential for making informed trading decisions. This module explores the fundamental factors that influence an option's value, as well as widely used pricing models that help traders assess fair prices and optimize strategies. The components of options pricing. An options price, also known as the premium, is made up of two main components: intrinsic value and extrinsic value. Intrinsic value represents the amount an option is in the money. For a call option, this is the difference between the stock's current price and the option's strike price if the stock is trading higher than the strike. For a put option, it is the difference when the stock price is below the strike. If the option is out of the money, its intrinsic value is zero. Extrinsic value accounts for additional factors beyond intrinsic value, including time until expiration and the expected volatility of the underlying asset. Options with more time remaining generally have higher extrinsic value, as there is greater potential for price movement. Market volatility also plays a major role. When volatility is high, extrinsic value increases, making options more expensive. Black-Scholes pricing model. The Black-Scholes model is one of the most widely used methods for calculating the theoretical price of European-style options. It considers several factors, including the stock's current price, strike price, time until expiration, interest rates, and volatility. The model provides traders with an estimate of what an option should be worth based on these inputs. Although useful, the model has limitations. It assumes that volatility remains constant and that markets operate without disruptions, which is not always the case in real-world trading. It also does not account for early exercise, making it less applicable for American-style options. Binomial option pricing model. The binomial model takes a different approach by estimating an option's price through a series of small time steps. At each step, the stock price can either move up or down, creating a decision tree that helps determine the option's value at different points in time. This model is particularly useful for American-style options, which allow early exercise, and for situations where volatility changes over time. Implied volatility versus historical volatility. Volatility is one of the most important factors in options pricing. Historical volatility looks at past price movements to determine how much a stock has fluctuated over a certain period. Implied volatility, IV, is forward-looking and is derived from an option's market price. It reflects expectations of future price movements. When implied volatility is high, option premiums rise, making options more expensive. Conversely, when implied volatility is low, option prices tend to drop. Traders analyze implied volatility to assess whether options are overpriced or underpriced and to adjust their strategies accordingly. Applying pricing models in trading. Comparing theoretical option values with actual market prices helps traders identify opportunities where options might be mispriced. Understanding implied volatility helps traders decide when to enter or exit trades. For example, selling options when IV is high can lead to larger premium income, while buying options in low IV environments can be more cost-effective. The choice between pricing models depends on the type of option being traded. The Black-Scholes model is useful for European-style options, while the binomial model is more flexible for American-style options that allow early exercise. By mastering these valuation techniques, traders can improve their decision-making and develop more effective options strategies. A strong grasp of how options are priced enables traders to assess risk, optimize trade execution, and manage portfolios more effectively. Thanks for watching. Please like, share and subscribe, and see you in the next module.